Thank you very much, Paul and Pat, and thank you everybody for the opportunity to speak to you today on what is a pretty major topic. I think Pat identified the key word in the topic of our presentation, limiting the risk of failure in financial institutions. I think there's a recognition that actually financial institutions will fail, and actually that is no bad thing, that bad institutions should fail, but it's actually the consequences of those failure, and it's limiting not only the failure, but limiting the consequences of those failure. What I'd like to address today is sort of three key areas. I will probably, as you can imagine, rapidly go through the first element, which is in connection with regulatory standards and requirements. I think Pat and Paul have very well covered that point, and focus on those areas around improved governance and risk management within banks, and then what is happening from the accounting and the auditing perspective in that regard. Again, I won't spend much time on this slide. I think it has been very well covered. I think the one observation, I guess, from an auditor's perspective is actually, I think, as Paul intimated, the forward-looking nature of the regulators, I think, is definitely a very positive aspect in that regard. And the way the banks are changing their behaviours to respond to that is good. I think the other element is actually there's a variety of key indicators that actually are being focused upon, whether it's core tier 1, leverage ratios, and or stress testing. Again, that variety, I think, is important. If I look back to what it was like in the early 2000s, it was very much focusing on a single number, and that sometimes can result in adverse behaviours. Perhaps I'll spend a little bit more time talking about the governance and risk management within banks. I think clearly what has happened since the financial crisis is we have seen a very rigorous focus on governance where board risk committees did not exist. We see committees created where they did exist. We see enhancements. It was interesting for Pat mentioned that those institutions where a board risk committee did not exist had more likely greater challenges and troubles through the financial crisis. I think it is a fundamental issue for any bank or any financial institution that the board takes ownership for the risk appetite that that institution wants to take, and then manage and challenge management against that risk appetite. And I think that is a key element that the financial institutions need to undertake to actually help the industry as a whole to better mitigate against systemic risk. I think the interrelationship between the board risk committees and the audit committees is key. I think one of the things that people understood or recognise as their risks, or what I call the financial risks, credit, market, liquidity. I think one of the emerging issues that has come out over the last 3 or 4 years is operational risks. What is the actual failure in technology and cybercrime and those impacts on institutions. So it's really important the controls around operations are equally understood and challenged as the risk management procedures. And I know there's a lot of concern and conversations I've had with chairmen of risk committees and chairmen of audit committees that things potentially fall between the gaps between those committees. So really understanding the respective responsibilities of risk and audit committees and making sure that they're working together effectively to oversight the risk and the control within the organisation, I think is an important step that financial institutions need to take to mitigate the risk of their failure. I think the third bullet point, actually on reflection, I probably should have put as the first bullet point. I think actually the key change that financial institutions need to take is a change in their values. I think there's a recognition that they were very focused on one stakeholder, the shareholder. One could be even tougher, one stakeholder, the employee, while actually they are a fundamental part of the economy of every country that they're in. And for those larger systemic institutions, actually they're a fundamental element of a much broader global economy. And the way that they behave and the values that they have are fundamental to how they as institutions are going to act and ultimately be perceived in the wider economy, and to address the point that Pat made at her initial introductions of her speech about the fact that even 6 years after the financial crisis, the bankers are still vilified in many countries, and they are still having to deal with the issues of the financial crisis and the poor behavior that they have exercised through that financial crisis. And to be frank, more recently, one looks at FX, some of the issues that are being identified then actually are in 2009 and 2010. So it is the values and the behaviors that financial institutions exercise is really at the core of how you're ultimately going to limit the risk of financial failure. I think if one sort of steps back a little bit and look into a little more detail around what the governance should be, I think it's an understanding of the risk appetite. That is where the Board Risk Committee interacts with the management. I think the next area, clearly, the interaction of capital, liquidity, and stress testing. I think banks are getting a lot better at looking at these forward-looking metrics and understanding what risks their business are taking on. If one's honest, if one looks back at 2008, I do not think many institutions actually understood the risks that they were taking, and they enjoyed the profits, but they hadn't really got a good understanding of the risk. I think there is the need, and I think, to be fair, they are getting better at understanding the risks that they want to take and those that they shouldn't be taking. And clearly, the change in regulation has helped there. I'll put a slight warning, and maybe it's one of the questions and we'll deal with later. Where do those risks end up? And I do have a slight concern that some of these risks still exist, but they may end up in unregulated entity in the shadow banking world. So maybe we are creating a safer regulated banking world, but creating a sort of a more risky shadow banking world. And the final point I want to make here is clearly the enhanced status of the risk functions, internal audit and compliance. Clearly that helps set the right tone within institutions about risk management and control. I think CRAs now are almost exclusively reporting to CEOs and are member of the executive committee. The internal audit are going directly to the chairman of the audit committees, and in many institutions compliance is an executive level appointment. So again, a reflection of some of the changes that banks and financial institutions have had to take. So what has the accounting and the auditing profession done to see some changes, and how have we responded to the challenges of the financial crisis? I think the first is pretty key. It's actually the changes to the standards under which the financial statements are prepared. I think everybody agreed that under stress, IAS 39 did not do well. It recognized too little, too late, to take the quotes of the FSB. I'm very encouraged that IFRS 9 has actually appeared in the summer of this year, and is going to be a significant improvement. I've put all three elements there, but clearly the impairment element is the key, with the requirement of expected loss and the requirement of management to look at forward-looking data in assessing the level of provisions that they will be required to book. So I think a very positive step. I know Pat and I have discussed this, and Nick, one of Paul's colleagues. It's going to be a challenge for the banks, it's going to be a challenge for the auditors, and it's going to be a challenge to the regulators. This will not be an easy standard to implement, and it will not be an easy standard to audit, but please recognise it's a step in the right direction, and we must thank the ISB for delivering that. I think two other standards, again, I think IAS 12 and IAS 13, one around the disclosures of off-balance sheet companies. I think securitization was clearly a challenge around the financial crisis. Understanding the interactions between financial services companies and off-balance sheet entities has been very important, and those disclosures are key. Fair value, again, I think it's as much the disclosure as actually the valuation. One of the challenges of fair value is when you get into that level 3, they're really difficult to value. And I think it's making people aware of the size and sensitivities of the level 3 assets and liabilities so that they're aware of how much is sitting on banks' balance sheets. I was, a year, 18 months ago, very encouraged that the FASB and the ISB were getting together and looking to produce converged standards. I think that was a very positive step. Unfortunately, it's a great disappointment that they are unable to do that on impairment, which is clearly a fundamental one for the banking and financial services sector. So while some good progress, that clearly was a disappointment. I reflect it's taken 6 years to get IFRS 9 issued by the ISB, and implementation date is 2018. That's 10 years. So I guess it's positive, but 10 years is an awful long time. And if there's something that we as a profession and the accounting standards setters need to reflect upon, it's how can one speed that process up? And I guess the FSB actually challenged the preparers and the auditors and the investors to do something around risk management. And that resulted in the creation of the Enhanced Disclosure Task Force, which I think actually has been a very successful body. In a 6-month period, it came up with some guidelines. By the end of the first year, many banks were implementing them. A year later, the vast majority of banks were implementing them. So I think we have seen the need for quick and rapid disclosure, and I think the EDTF is a good example of how the profession, the preparers, and the investors have looked to enhance the communication with the stakeholders. Again, I guess a slight concern or a warning shot at the bottom of this slide. If I look at a number of the clients that I interact with, 4 or 5 years ago, their financial statements were 200, maybe 250 pages long. They're now somewhere in the region from 600 to 800 pages long. In addition, they have Pillar 3 disclosures under Basel II, which run to another 300 or 400 pages. While I believe enhanced disclosure is definitely a step in the right direction, there is a risk that the key information is lost in the vast plethora of information that is put in the public domain. If I move on to the auditing profession, I think there's sort of 2-3 things I want to focus. There's additional guidance that have come out across a number of territories. In my own territory in the UK, the Institute issued Practice Note 19, which is around how to audit banks, and I think that was greatly received. I know the IAASB is thinking about whether they should issue some specific guidance or standards around the auditing of banks. If I stand back and reflect as an auditor, what have I seen changed over the last 5 or 6 years in the way we as a profession address the audits of the banks and actually have reflected the change that's been going on in the wider space? I think there's sort of 4 things that spring to mind. I think, Pat mentioned a couple of them. I think there is now a much greater use of specialists and experts. I think 2 clear areas: the fair value of financial instruments and impairment. I think the auditors are now a lot more challenging of management's assumptions and actually look to get a much broader understanding of what the potential assumptions that could be used, rather than perhaps in the old days we look to find evidence to support management's assumptions. So again, a reflection of a need for greater challenge and skepticism of the assumptions that management are using in particularly the key judgments. Impairment and fair value are 2 that spring to mind. I think as technology advances, the processing gets cheaper and data storage gets cheaper, the actual use of data auditing, where actually you take the entire population of loans and re-perform the calculation of the impairment provision or re-perform the valuation is definitely, I think, a way that auditing is moving forward. So rather than sampling, we will be testing the entire population. So comfort over 100% rather than a small sample. The final point I want to make here is consistency. I think if one's frank and one looks back in the early 2000s, there was perhaps a diversity of what the various firms and countries were doing across the auditing of banks and financial institutions. I think with a number of the measures that are identified here, consistency and enhancement of quality is clearly something we as a profession are focused on without a doubt. The last 2 points I think probably have been covered. Engagement with regulators, I know both Paul and Pat identified that. I think the audit profession is very keen to enter into that. I think the key thing is this is a two-way dialogue. It's important that auditors share and raise their concerns with the regulators as and when they are identified. I think if there's a request from the audit profession, it's regulators, you have access to lots of interesting and different information, and please do share that with us, because that will make the performing of our difficult task easier. So a really important thing, but a key two-way dialogue. And again, the final one, I won't spend a lot of time because Pat talked about it and I'm probably running out of my 10 minutes, was the Basel guidance on audits of banks. Again, I think we, by and large, strongly supported what was within that and felt that much of it was what we'd have deemed as best practice within ISAs. There's a couple of areas that Pat and I might not 100% agree on, but I think in the sentiment of what the document was saying was definitely a positive in the audits of bank in that respect. Really, just to summarize, I think, there is a lot of positive things that have been done, and clearly the journey continues. But just to sort of reiterate, I think the key thing for financial institutions is the quality of the governance and the quality of the management and the cultures and the behaviors of those institutions. And actually getting those things right will be the key element of limiting financial failure. Thank you very much.